The psychology of taking profits and cutting losses is where trading stops being a technical exercise and becomes a mirror, because nothing exposes your relationship with fear, greed, and self-worth more clearly than the moment you have to decide whether to lock in a gain or admit you're wrong. After decades in the market through bubbles, crashes, and long grinding periods where nothing seems to work, I can tell you this with absolute certainty. Most traders don't fail because they can't find good entries. They fail because they cannot emotionally handle the consequences of being right or wrong once money is on the line. Let's start with taking profits, because that's where greed hides behind logic. Early in my career, I thought holding winners was a sign of strength. I told myself I was being patient disciplined, letting profits run. Sometimes that was true. More often it wasn't. More often I was afraid to sell, because selling would end the story. As long as I stayed in the trade, the dream of more was alive. The problem is that the market doesn't pay you for dreams, it pays you for realized decisions. I learned painfully that unrealized profits are not rewards. They are temporary permissions granted by the market, and those permissions can be revoked without warning. What makes taking profits psychologically difficult is that it forces you to accept imperfection. You will never sell the top consistently. The desire to do so is not ambition, it's ego. Every trader wants the satisfaction of being right all the way, of squeezing every last dollar out of a move, because it feels like validation. But markets don't validate you, they test you. The longer you stay in a profitable trade without a clear plan, the more that profit stops feeling like a bonus and starts feeling like something you own. And the moment you feel ownership, you also feel entitled, and entitlement is where discipline quietly dies. Cutting losses is even more revealing, because that's where fear and pride collide. A loss forces you to confront the possibility that your read was wrong, your timing was off, or your understanding was incomplete. None of that feels good. The brain reacts to losses as threats, not data, and when threatened, it looks for ways to delay pain. That delay often shows up as moving stops, widening risk, or telling yourself a story about why the market is temporarily irrational. I've done all of it. Every experienced trader has. The market punishes this behavior not out of malice, but because reality doesn't bend to comfort. One of the most damaging psychological traps is asymmetry. Traders often cut profits quickly because they fear losing what they've gained, but let losses run because they fear being wrong. This creates the worst possible math: small wins, large losses. What's insidious is that this pattern feels emotionally reasonable in the moment. Taking a profit feels like relief. Holding a loss feels like hope. Over time, relief becomes addictive, and hope becomes expensive. Until you confront that emotional imbalance directly, no strategy in the world will save you. During the dot-com era, I watched traders ride massive winners and feel invincible, only to give back months of gains because they couldn't let go. During 2008, I watched others refuse to cut losses because the fundamentals hadn't changed, even as liquidity disappeared and price collapsed. In both cases, the underlying issue wasn't analysis, it was identity. They weren't managing positions, they were defending narratives about themselves as smart, patient, or principled. The market doesn't care who you think you are. It only cares what you do. Another psychological layer people underestimate is regret. Regret operates in both directions. If you take profits and the market keeps going, regret tells you you were too cautious. If you don't take profits and the market reverses, regret tells you you were greedy. If you cut a loss and price comes back, regret tells you you were weak. If you don't cut a loss and it keeps falling, regret tells you you were stupid. Regret is unavoidable. The mistake is trying to trade in a way that avoids it. You can't. What you can do is choose which regret you're willing to live with, because one of them is survivable and the other compounds into damage. I learned over time that the goal is not to feel good about exits, it's to feel clean about them. Clean means you did what you said you would do when your mind was calm. Clean means your action aligns with your rules, not your emotions. When you start judging your decisions by outcome instead of process, psychology takes over completely. You feel smart after lucky wins and foolish after disciplined losses, and that inversion slowly erodes confidence and consistency. There's also a deep connection between profit-taking, loss-cutting, and self-trust. If you repeatedly override your rules to chase a little more or avoid admitting you're wrong, you teach yourself that your plans don't matter. Once that trust is broken, every decision becomes harder. You hesitate on good exits and rationalize bad ones. The market hasn't changed, but your internal stability has. Rebuilding that stability is far harder than protecting it in the first place. As this starts to sink in, you realize that mastering the psychology of taking profits and cutting losses is not about becoming fearless or perfectly rational. It's about designing rules and habits that protect you from your most predictable emotional reactions. Because those reactions will show up again and again under pressure, and unless you've prepared for them in advance, they will quietly take control at exactly the moments when the stakes feel highest and your judgment feels most urgent. And that realization is where we need to continue next, as we move from understanding the emotional traps around exits into learning how to build practical frameworks that make taking profits and cutting losses automatic rather than negotiable, so that when the moment arrives and the numbers are flashing on your screen, you are not asking yourself what you feel like doing, but simply executing what you already decided, when your mind was clear and your ego was quiet and your discipline was intact. And that is where this thought carries forward into the next part, as we begin to talk about how to structure exits in a way that works with human psychology instead of fighting it, and why that structure is the real edge. Most traders never develop until after they've paid far more tuition than necessary, and that is exactly where we go next. As this sentence continues into the practical side of turning insight into behavior and behavior into consistency. By building rules that assume you will feel fear and greed at the worst possible moments, and remove your ability to negotiate with yourself when they arrive. Because the mistake most traders make is trying to fix psychology with willpower instead of structure. The first practical shift that changed everything for me was separating exits into decisions made before the trade and actions taken during the trade. Before entry, when nothing is at stake, emotionally, you define three things. Clearly, where you are wrong, where you will reduce risk, and where you will take profits if the market offers them. Once the trade is live, those decisions are no longer up for debate. You are not evaluating how you feel, you are executing what you already decided. For cutting losses, the most important psychological protection is tying the stop to invalidation, not pain. When your stop is placed where the idea is clearly broken, taking the loss becomes an act of consistency rather than an admission of failure. You are not saying I was stupid. You are saying this scenario did not play out. That subtle shift matters enormously. It turns losses into information instead of judgments about your intelligence or worth. Over time, this reframing reduces hesitation because you are no longer protecting your ego. You are protecting your process. Another powerful tool is pre-acceptance. Before entering any trade, I accept the full loss defined by my stop as already spent capital. If I am not comfortable with that loss emotionally and financially, I do not take the trade. This does two things psychologically. First, it removes shock when a loss occurs. Second, it prevents you from widening stops to avoid discomfort, because the discomfort was already acknowledged and accepted. Losses still hurt, but they don't surprise, and surprises are what trigger panic and bad decisions. Taking profits requires a different kind of structure because greed is quieter and more persuasive than fear. One of the most effective frameworks I've ever used is scaling out. Instead of forcing yourself to choose between selling everything or holding everything, you predefine partial exits at logical areas of opposing interest. This allows you to pay yourself for being right without killing the entire opportunity. Psychologically, this reduces pressure immediately. Once some profit is realized, the remaining position becomes easier to manage rationally. You are no longer protecting a fragile, unrealized gain. You are managing house money with defined risk. It's also critical to align profit-taking with market behavior rather than personal desire. If momentum is strong and structure is holding you, stay with it. If momentum slows, volatility shifts, or acceptance fails near a known level, you act. You don't wait for the perfect top. You respond to information. Traders who struggle with exits often treat profit targets as promises instead of possibilities. The market owes you nothing beyond what it is currently offering, and learning to take what is offered without resentment is a major psychological milestone. Another habit that stabilized my exits was measuring success by rule following instead of outcome. At the end of each week, I don't ask how much I made. I ask how many times I followed my exit rules under pressure. This retrains your brain to associate pride with discipline rather than profit. Over time, that conditioning changes how exits feel. Cutting a loss cleanly becomes satisfying. Taking a reasonable profit feels responsible rather than timid. This is how self-trust is rebuilt and maintained. You also have to make peace with regret as a permanent companion. No exit strategy eliminates regret. Every decision creates an alternate reality where the other choice would have worked better. The goal is not to avoid regret, but to choose the type that does not threaten your survival. Regretting that you didn't make more is survivable. Regretting that you didn't cut a loss early enough is often not. When you internalize that hierarchy, your exit decisions become calmer and more consistent. Over many years, I came to understand that the psychology of exits is really the psychology of self-respect. Do you respect the rules you set when you were calm? Do you respect risk enough to accept being wrong quickly? Do you respect opportunity enough to take profits without demanding perfection? When those answers are yes, trading becomes less dramatic and far more durable. You still feel emotion, but emotion no longer dictates behavior. And that's the real edge here. Not emotional suppression, not perfect discipline, but systems that assume you are human and protect you accordingly. If this lesson resonated with you, I invite you to subscribe to the channel so you can continue learning from real market experience rather than theory. And leave a comment sharing which side you struggle with, more taking profits or cutting losses. Because bringing that struggle into the open is often the first step toward building structures that turn it from a weakness into a strength.